the first observation is I'm not a trader. I think that you need to be a professional proprietary trader to have a short time horizon. So I don't really think anybody should buy it unless you have a 4-year time frame. And I'm hoping that you want to own it forever. I think that Bitcoin is one of those forever assets, like the family farm, or like a trophy. You know, if you bought like the New England Patriots or a soccer team, you know, you want to give it to your heirs. So I have a lot of opinions about the long term, 4 years to 10 years out. I don't have any particular useful advice over the next 4 weeks, you know, and I'm not a technical person. So, and I hear all sorts of things, so we can talk about it, but that's just what I hear in the market. And I'll have a lot more to say on Bitcoin in a moment, but I'm going to leave it at that. With regard to the macro economy, you know, I think that the economy of the world, like I would say Western civilization, but maybe I actually think the entire global economy peaked in January of 2020. I think if I think about January 1st, like New Year's of 2020, just before, you know, we got hit with COVID, and I think about how the world worked, you know, the concert business was raging and travel was raging and the airlines were working smoothly and the hotels were on fire and small businesses were on fire and there was entrepreneurialism everywhere and an explosion of yoga studios and specialty everything. I think we kind of hit the peak of this entire business cycle then. Everybody was able to go about their business unfettered. We had a little bit of monetary inflation in the system, and so it wasn't like things were perfect. They weren't perfect, but you know, compared to what came in the next 2 years, you know, which is just unprecedented government intervention in every aspect of our lives, to telling you who could come to dinner, how far away you had to stand from your kids, how many masks you need to wear, how many vaccines you need, whether or not you can go to the gym, whether you could go to the office. You know, so many things happened that intervened with the free market, and they're all restraints of trade, creating massive inefficiency and all this. I think policy intervention unprecedented across every dimension of life. You got a war on carbon, a war on corporations, a war on foreigners, a war on trade, you know, a war on COVID. You know, I could go on and on and on, but wars are unprecedented policy interventions by governments in our lives. So if I go back to January, and I just picked like January 1st, 2020, while we were still innocent and before COVID hit and then the war on currency hit, etc. And then you go forward to today, and I look at what happened. Well, the money supply, the M2 money supply of the US dollar expanded, by my chart, 41%. We expanded the money supply about 41%. Now, how did all the assets behave? Well, gold is up 20% since that day. So gold captured half the money supply expansion. It didn't track the money supply. What did track the money supply? U.S. single-family homes up 46%. You know, we all know the story of home prices exploding. So single-family homes slightly outpaced that money supply. And of course, granted, the money supply is like an imperfect government metric. You know, they give you their best estimate with a 1 or 2 month delay. So, I mean, it might be the single family homes are about at the money supply. NASDAQ, the index, 19% from that date. Up 20%, but the money supply is up 40%. The S&P index up 13% from that date. Bitcoin up 185% from that date. So, you know, and if you picked a broad commodity index, I think the commodity index up double the U.S. home. So you would have beat the money supply slightly with desirable real estate, You would have beat it with commodities. You beat it with Bitcoin, which is like a basically synthetic digital commodity, but it's scarcity. You wouldn't beat it with gold. You wouldn't beat it with NASDAQ stocks. You wouldn't beat it with the S&P index. And so, you could roll the clock forward. You can roll it to August 10th, 2020. That's the date that my company bought $250 million worth of Bitcoin. And so people knew who I was on that date, and we made a macroeconomic commitment. Now, we've been studying it for 90 days previous, and so we made a commitment based upon the circumstances in the second quarter. But if you look at the macro numbers from August 10th, if we had bet 250 million on Bitcoin, 250 million on gold, it would have been down 10%. Gold is down 10% since August 10th, 2010. So gold got a boost in the first part of the crisis, but then it kind of flagged. NASDAQ is like flat, minus 1%, 0%, went nowhere for the entire 18 months. The S&P slightly up 11%. Single family homes up 26%. The money supply up about 20%, maybe 25%, depending on how you count it. So again, single family homes tracking the money supply. Bitcoin, even as it's been thrashed right and left, up 86%. So if your time horizon is less than a year, you're a trader. Even if it's less than 2 years, you're sort of a trader. And if you're a trader, you can be right or wrong about anything in that 18-month time frame. You could have said you're an idiot not to buy Amazon stock when it was whatever, and you're an idiot not to have sold it after it doubled, and you're an idiot not to have, right? You can just drive yourself crazy if you're a trader. And so that's why I don't join with the traders. I just don't know it. I think you need to have proprietary expertise of some sort. But what I can say is if you're an investor, you kind of got to have a 4-year time horizon or longer. And if you're a saver, you're a 10-year time horizon or longer. So I think the macroeconomic environment was strap in for a wild ride. And that was like a given as of March 15th, 2020. Around March 15th, Sven, I think the 30-year yield was maybe 1% for the US bond. The swap rates were 72 basis points. So the 30-year swap was 72 basis points. And I remember it vividly because I entered into a trade for 72 basis points because I thought, why not? Now, if you look at the way that that's moved, it's just been a roller coaster ride. But you would know that, if a reasonable price for 30-year money was 4% or 3.5%, and if the swap rates were 72 basis points, there's going to be hell to pay, as we come out of that, in essence, free money environment. And the only question is what's going to happen. And of course, if you look at the swap rates right now, the 30-year swap is 298, but it was 311 like yesterday, or 315. It's flopping all over the place. The 2-year swap rate is 358 basis points. So we've got basically interest rates have been jacked on the 2 years of the 1 years from 0 to 360 basis points. The yield curve is flat. It's worse than flat. It's inverted. There's yield curve control, right, in Japan, where they're pegged at 25 basis points. And if we, look at these currencies, right, and what's going on with them and what's going on with the bonds, well, look, just the currencies year to date, my charts say the dollar strengthened against the yen 17%. Against the pound, 10%, against the euro, 7%, against the franc, 5%. These are massive moves. Year to date, the 2-year, has gone from 76 basis points to 310. So I think we got on a wild roller coaster from a macroeconomic point of view starting in March, 15 days to stop the spread. You remember the 15 days stop the spread? 2 years have gone by, 2.5 years have gone by. My office is like 10% occupied. There's no 15 days, not 15 months. Call it 4 years after that happened, we will get to a new normal, and we will never go back to the old normal. So macroeconomically, if you're looking for any good idea with a time horizon of less than 2 or 3 years, even 4 years, you're just a trader. And right, I think there's something wrong. There's a moral hazard to making 99% of the population traders. Right, the real moral hazard of the government monetary policy is by pegging the interest rates to zero, and by yield curve control, they've demonetized the currency, or they've eliminated the currency as a store of value for savers, and that means they've forced retirees. It doesn't matter retirees. It doesn't matter whether you're 20, 30, 40, 50, 60, or 70. They were forced non-financial investment professionals to take risk. Forced them to take risk. And then the cruel joke of it all is, in addition to destroying your savings account and destroying sovereign debt as a store of value, they also have put equities on a roller coaster. So that, if we look at the roller coaster of the S&P index or the NASDAQ index, if I can't buy the bonds, I got to buy the index. And they put the indexes on a roller coaster, and they put them on the roller coaster by, I don't know if your memory's good. You might remember, a certain head of a central bank saying, we're not even thinking about raising interest rates until the year 2024.
I had my microphone on mute, so
But do you remember that?
Thinking, folks. Yes, I do remember that. I know who that was too.
So what? By the way, is it 2024 yet?
Yeah, we're getting close to it, aren't we? It feels like it. I don't know. Time is a morph.
The irony is, you're sitting there watching interest rates at zero, and they're saying, well, it's 4 years. Okay, well, 2 years later, and we're getting a 75 basis point. And we're back to the observation. You probably want to own digital monopolies, like companies that have more power than governments. A Google or an Apple, right, probably has more power than 175 governments in the world. They will probably outlast the currencies of all those governments, right? I mean, and they have pricing power, and they have massive leverage. And if I gave you $500 billion and I said, replace Apple, build your own Apple, your own iOS, right? You probably couldn't do it for $1 trillion. If I gave you $1 trillion in cash in today's terms and said, replace Apple's franchise, it's not clear that you could rebuild that tech stack. And likewise, if I stacked a huge amount of money and said, replace Google, it's just not clear. Can you replace Google and YouTube and the network effect with $500 billion? Now, so there are certain things you want to own through turbulent times. Monopolies, right? I mean, it turns out, right, that John D. Rockefeller went into the Great Depression, and all those oil companies came out the other end of the Great Depression. And they're still pretty powerful companies 100 years later, right? If you have an energy monopoly or the like. So I think if you're owning digital monopolies that provide the basic elements of the 21st century, and they're companies, they're kind of transnationals, right? They will find a way to raise their prices, and or at the end of the day, you remember when I think Australia had an issue with Facebook, and Facebook said, okay, we're just shutting down in Australia, right? That they will literally have negotiating leverage against an entire country, right? And so that's a safe place to be. Do you want to own small, mid-sized companies, private businesses? You get rolled over, right? Like, we wiped out an entire, 18 entire segments of the economy without batting an eyelash. I'm not going to say what they are because I don't want to be negative, but there are entire parts of the economy where there's no safe haven. Owning trophy assets, probably. Owning trophy real estate, you'll probably do okay. You just, at the end of the day, if you're owning real estate, you just have to calculate the property taxes and the carrying cost, the risk of having it seized by eminent domain, the property tax risk, the maintenance cost risk, etc. If you're owning a company, you got to decide if you trust the management team and are they going to rip you off, or are they competent, and is it an institution that you want to be in bed with for 20 years, at least for a decade, right? Yes or no? And then otherwise, you want to own something very scarce and desirable. So if you look at the crypto universe, the idea of crypto is to have some kind of property that's in lieu of a currency or in lieu of a commodity. There's 19,920 cryptos according to CoinMarketCap. One of them amounts to about half of that market cap. That's Bitcoin. So there's one thing that had a fair distribution, an ethical distribution. It's been deemed universally as a commodity. There is no issuer. There's no management team. Satoshi's gone. There's no the protocol was set at version 0.1, not change, right? 21 million, 1 megabyte block size, 10 minutes a block. The mining rewards were set for until the year 2140, right? Everything is set for the next 120 years as of now, 13 years later. You've got this one thing, as Chair Gensler would say, a commodity is something without an issuer. There's no issuer of gold or corn or soybeans or timber or Bitcoin. A commodity is a much higher form of property than a security. A security has an issuer. The highest form of security, if you must own a security, is own Apple or Google or Microsoft, because they are transnational, publicly traded monopolies that have a very mature management team, mature governance structures. They are embedded in the middle of 100 million corporations, right? It's kind of hard to see how you rip them out if you must own a security, but they're still inferior to a commodity, or in this case, Bitcoin is better than a commodity. It has the legal, ethical standing of a commodity, no issuer. It's universally useful, right? But it is a scarcity because there's only 21 million. And if you look at my Twitter feed today, I posted an interesting video of the Uganda gold find, where they found enough gold ore in Uganda to create 330,000 tons of gold, which means it would not triple, but 2.5, almost triple the gold supply, or the supply of gold that we have found since the beginning of time on this earth.
Is that right?
So gold's the king commodity, and it's the highest stock to flow, but it's still just a commodity, and it's infinite. You can make more in human ingenuity, and given a high enough price, or if I increase the price by a factor of 10, you get a lot of incentive to turn that ore into refined gold. And the same is the problem with oil, natural gas, soybeans, corn, steel, lumber, the like, even real estate. Real estate's valued based on the square foot. And so you got 1 million square feet of commercial real estate. How scarce is that? Well, it's scarce until I create 10 million more square feet of commercial real estate, and it's less scarce. And so if you look at this in that way, what you realize is there's one digital commodity that is a scarcity. And if you have a long time horizon, if you're willing to wait a decade, if you're willing to live, if you're willing to be beat this way and that, tossed on the stormy seas of fate by the monetary winds that blow, they will blow in your face, they will blow to your back, and if you're going to stand on the deck or lash yourself to the deck, and you're prepared for a very rough journey, you should be able to make it to the promised land with 100% certainty. Not 100% certainty, but it's an opportunity, right? And in my opinion, the odds are better of a good outcome than the odds that my ancestors took when they left, Lucerne, Switzerland in 1730, and they sailed to Philadelphia, right? And that was dangerous. And that's not nearly as dangerous a journey as when people left Europe to go to Australia, where they had like a 30% mortality rate. I think the mortality rate, going to the New World was like 5%, right? It was dangerous.
No, absolutely. Yeah.
So I was saying that the macroeconomic winds are blowing, and if you're an investor, you just have to decide how you're going to deal with it. And I think one choice is be caught up in the maelstrom and attempt to trade your way out of it by slavish devotion to the news of the day and attempting to predict what the central bank will do, and then try to figure out whether or not this is a good entry point or not a good entry point. And that's a recipe for anxiety, especially trying to pick the bottom and pick the top. And that's hard.